Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. 1 o'clock on the East Coast in the aftermath of a Super Bowl market call. Dan, Nathan, Guy Adami on this February 10th. Month is flying by. Letter G, how are you, Dan?
I'm doing great. Anything but a Super Bowl guy, don't you think so?
Well, for me, and this is coming from a diehard, ardent Giant fan.
Yeah.
I was rooting for the Eagles of Philadelphia. As a matter of fact, and I rarely say things that I was right about, but on CNBC's Fast Money, I think on Thursday, I said, take the Eagles and the money line and the over. And that proved to be somewhat prescient, I guess. The Chiefs, to me, were all smoke and mirrors this year, and they got exposed on the game's biggest stage, which makes me quite happy because I'm tired of their shtick.
Okay. I love that. That wasn't even a rant for some of you folks.
That wasn't a rant.
No, I'm just saying.
People waiting for a rant. I'm sure something will come up about the rant, like the halftime show, but I digress.
Yeah. A lot going on here today. We're going to talk, Guy, a little bit about some of the stuff that's rallying and some of the stuff that is not. This is a third week in a row where I think the term you like to use is like a tape bomb out there over the weekend, and the reaction pretty benign. I don't know. We got some data this week. We went over that on the Risk Reversal Pod with Liz Young Thomas. That's in your favorite podcast store. Where do you want to start?
Well, let's put the slide that Amanda made. So now it's 3 Mondays in a row where we've seen some pretty significant moves. Obviously, that DeepSeek Monday. Early on in the day, it looked like it was going to be somewhat cataclysmic. The market clawed its way back by the end of the day. Then last Monday with the tariff stuff, and now here back more tariffs. But the market says, you know what? We've heard this song before. We're going to sort of turn the tables on you, and the market's up 0.5% or so. So these Mondays, over the weekend tape bombs, and I guess the reality is you're just going to have to get used to it because I think you're going to see more and more of this, especially when you have a weekend to sort of digest things and to listen to what's been said or written about.
Yeah, and I guess the other thing is, and if you go back to the 2017, 2018 Trump playbook, sooner or later, it's kind of like the boy who cried wolf, right? You can go out there, you can put these big proclamations out about what you're going to do and what you're not going to do. But, aluminum and steel, pretty important for manufacturing here, and I think it was back in 2017, 2018, I read this over the weekend, Guy, after those tariffs were put on steel and aluminum, massive decreases in, imports of those. And what does that do when you have scarcity, of those sorts of materials to kind of manufacture? The price goes up, and that's kind of pretty inflationary.
It's interesting you say that because it was, I believe, March of 2018, if memory serves, when they talked about steel tariffs. And Amanda, we've done this before, but there might be some new people in the audience. U.S. Steel was lower left, upper right up until that point, the spring of 2018. Those tariffs were announced, and then those stocks fell off a cliff. So, again, the rhetoric around this was, I'm saving the steel industry, but in terms of what the stocks did, it's anything but. And if you can put your cursor to, that peak in sort of, again, March of 18, bang, right there. I guarantee if you go back, and that was, Dan, March, that was around the time the tariffs were announced, and you saw the subsequent move. So I think your point, though, in terms of the boy that cried wolf, or diminishing marginal returns, I think the market is figuring it out, I think, quicker this time than the first administration in terms of, the rhetoric and then what it potentially could mean to the markets.
Yeah. And I just say this, the risks are very different this time around. When you think about what they have learned, this is the Trump administration, or at least him and a close bunch of advisors from that last, go around, is that people have the playbook, right? And so it just depends like how much they kind of stick to it one way or another. And, the other thing is just like, if you want to put these sorts of tariffs on Canada, you run the risk, man. That economy, Guy, grew, I think, at 1.5% last year versus our 2.8%. The unemployment rate here is 4% versus 6.5% there. Look at China. We know that their economy is very weak. Youth unemployment is through the roof, right? Like they have massive deflation. If you put too much pressure on some of these other economies, some of our biggest trading partners, you're going to end up with weak global growth. and it's going to be imported here. And then you might find yourself in a stagflationary environment. And, just the last thing is, like, I think I read this earlier. I mean, that lead in the House, the Republican lead, is like the smallest lead in, I want to say, like, over 50 years or something like that. So there is a large group of House members on the right that are just not for most of this policy, right? Like, if you think about it, so they run the risk of really getting stuck in the mud as far as their pro-growth agenda, and it won't take much. And I think David Rosenberg said this last week. He thought that, threatening our allies with these sorts of tariffs could potentially be a huge misstep.
Yeah, and you might as well throw the sectors up. And while we throw this slide up, I'll say the following. When everything is viewed through the binary lens of wins and losses, when you see a trade deficit with a country, a deficit is perceived as a loss. And really all it means is we're just basically importing more of their stuff than they're importing of our stuff. It doesn't mean we're winning or losing. It's just sort of the way the economics and the trade relation is. It's, again, to me, it's a very one-dimensional way of looking at things, but that's the way things have been looked at. And I'm not saying I'm right. That's just the way I view things. So, but to your point, the market's seemingly digesting it. What I think is going to wind up happening, though, and, this is probably a conversation we will continue to have, is what does it mean for interest rates? And, we can throw a TLT up after this and we'll take a look at it, but that's a conversation. Today, though, the winners are as follows. I mean, pretty simple. Energy's winning and banks are losing. And I think that's for a myriad of different reasons. And I do want to look at the banks, because if you look at this chart, Dan, that Amanda created, we're right up against that prior resistance. And we once again traded up to it, seemingly, and I want to be careful here, seemingly have failed. So we'll see how this plays out.
Yeah, and this is one that, again, you could have looked at this chart in a couple different ways, especially last Thursday and Friday, and said this is about, on the precipice of a really big breakout. And so today yields aren't doing a whole heck of a lot. Maybe I don't know what's going on. I was kind of searching for some news on this front, and maybe it just feels like, maybe it's a reflection on the potential for slower growth, and maybe that's the knock-on effect that we saw after the jobs report. So again, I'm in that camp. And why are we using the BKX versus the XLF? We know that it's just a broader, if you look at the top holdings there, it doesn't have the Berkshire Hathaway and the like here. So interesting stuff to me. Another area, Guy, that I thought was weak today, and I couldn't find too many reasons for it, was the airlines. And if you look at this is the Jets ETF. This has obviously been a huge performer. It's been driven by United and Delta. American joined the party late last year. But again, is this because crude oil's up and maybe there's some fear about a consumer weakening? I don't know, but this is one of the best performing trades over the last, call it, 6 to 9 months.
No, without question, I saw the same thing that you saw, and I think part of it is probably higher crude, although, $72 WTI is something we've seen, pretty much for the entirety of the last year. So, but with understanding it's a one-day event, we'll see how it plays out. But to your point about the consumer, is this the beginning of a tell when you sort of overlay that on top of banks? Those are the types of things we're trying to dissect. The next chart, though, to me, this is the one that's interesting. And this is, this is yields. This is a TPI. This is obviously yields have been in this downtrend. I think we traded down to the lower band of it, and we're seemingly bouncing here. It felt as if 4.25 might have happened on the back of maybe a retrace to the 200-day moving average. But if we throw a TLT chart up real quick, this is the line that I'm really focused on. So this downtrend's been in place since the fall of last year. Obviously, TLT has been declining. We've seen some bounces along the way. The bounces obviously mean rates have gone down. But the question I think the market participants have to ask themselves now is did we just make the third point of a downtrend? And are we going to test the levels that we saw in the fall, not of last year, but if you go in longer term, the fall of 2023? And, I'll say again, that's where I think we're headed. 82 or so, whatever that low is, Amanda, in October of 2023, I think that's where we're going. So comes in around what, Dan? You could probably see it clip better than I can.
Yeah, it's
82
like
and change.
Yeah, 82. Listen, it's a tough one because, this 10-year yield has not been trading. We've made this point, since the fall, right? When the Fed cut 50 basis points in September. And what did we see? We saw the 10-year yield just go much higher. It went from 3.6% to 4.5% or something like that. And then we started pressing a bit higher. The technicals of this one is interesting. Let's go back to a 1 year for a second, you see that 200-day moving average. It's up there, what, 92.71. And so if you were to break out above this downtrend and purely from a technical standpoint, maybe you get to 92.71, maybe 93. Now let's go back to that. This is the TLT. This is the 20-year, right? So let's go look at the 10-year yield. So the TLT is going to act inversely to yield. And you look at this thing, it's a well-defined downtrend. I mean, if it were to kind of break below that lower band, it's kind of the opposite what you see in the TLT of potentially breaking out. And then you get to like that 4.25, 415, which is that December low, if you will. So it's kind of interesting how closely you can think about these from a technical standpoint inversely. But, and the only reason I'm making this point is because it's the 20-year ETF versus the 10-year yield. But, guys, the one thing I'll just say is that let's pull up the DXY, the dollar, for a second. I know we're going to kind of get to, gold and some other stuff, but I think the Dixie's worth kind of taking a look here because, we have those lines. We put in the kind of uptrend. When that was broken to the downside, it becomes resistance. So if this thing were to get back on its horse, you see 110, you probably see, to your point, yields higher, right? And then slower growth and maybe weaker gold, weaker crude, that sort of thing. But a lot of those traditional relationships have kind of broken down of late.
Yeah, well, I think you're right. If the dollar were to start heading higher, my sense is it's probably because yields have headed higher. I think yields will lead the currency, but it doesn't matter. I mean, that's just sort of why I think it's a causation thing. But to your point, let's just go to the chart of the day, and that is gold. I mean, you're right to bring up the historical norms have not been holding serve at all. As a matter of fact, gold, when yields were going higher, gold was hanging around like a champ. Obviously, the dollar was higher, gold was hanging around. Now that things have seemingly turned, gold's on its horse. And then you read over the weekend that the Chinese potentially could allow their insurance companies to buy gold. And it's sort of, it appears as though the horse is out of the barn. That, in addition to something that I read from Peter Bookvar over the weekend, talking about the potential for either Treasury or whatever agency would be able to do this, sort of mark up the gold price or mark to market where gold is, seemingly looking at gold as potential asset. I think the gold market all of a sudden is like, wait a second, what are you folks going to do here? What's going on? So to me, all roads are leading to gold, and we really haven't strayed that far from it. And we're talking about gold approaching $3,000 an ounce.
Yeah. And gold leads us to Nerd Gold Guy. And, there was an article that caught Amanda's, who caught her eye on Moneyline. They have a daily newsletter. You guys should check it out. They are a great partner of ours, as you know. But when you start seeing headlines like this, cryptocurrency risk management strategies, you got to kind of get your antennas up a little bit. A lot of that has to do with some of the engagement they have, I'm sure, with their customer base and some of the traffic that they see to their site. And these are kind of logical suggestions here. Invest what you're willing to lose, use reputable exchanges. There's lots of ways to obviously get exposure, let's say, to Bitcoin in particular these days. But Guy, when I think about the risk management strategies as it relates to crypto, you got to start thinking about the reasons why it's moving higher. And, you and I have kind of bandied about this for years now, it feels like. And, when I think about it, is like, okay, not too different than what you just laid out about gold. There is there's a situation where you have scarcity, right? You have this notion that it's, a hedge against, the decline in the US dollar. There's inflation, hedging ideas, that sort of thing. And, a lot of the pillars of the bull case really have just kind of come down to, because of the kind of diminishment of some of those sorts of logical sort of relationships and how they've been abandoned. It really has just become a store value based on scarcity, right? And so, give me your 2 cents on that.
No, it's interesting. The scarcity, and listen, this is what makes markets, right? The scarcity thing to me never really helped. I mean, there are a lot of things that are scarce that have no value. And just because, Bitcoin theoretically has a finite number of 21 million or whatever it is, to me, that alone isn't a reason. I don't think you're saying that. I mean, I understand that's a pillar of the bull case, but it never really made all that much sense to me. Is it the utility of it? Maybe. But then you have to look at it and say, what's been holding it up here? I think there's this hope that it's become some sort of, an asset in the Treasury's balance sheet, a Bitcoin reserve. I think a lot of people are holding out for that. And the fact that MicroStrategies on a weekly basis continues to add to the position. So they're seemingly the buyer, and I don't want to say of last resort, but obviously they've been a pretty significant buyer. I think they're up to about 480,000 or so Bitcoin. I think their average price now is probably north of 65,000 or thereabout. I mean, my concern continues to be that they will continue to buy. Their average price will continue to go up. And if they do that in tandem with potentially Bitcoin going lower, and you sort of meet in the middle at around 74,000 or whatever that gap is that we drew, that's going to be problematic, I think. Now, obviously, we're not there or close to being there, but that's what I'm looking at, and that's what's on my radar screen.
Yeah, so in Q1 of last year, you had this big run up. I think it was from 40,000 up until about 70,000. Then you see that long consolidation, and that's when a lot of Bitcoin ETFs were issued. So the issuers had to buy the underlying, and then you had a lot of folks kind of getting in there. And this goes back to that kind of point that was in that article from Moneyline, is like, use reputable exchanges. Well, when you're buying an ETF from like Fidelity that has the Bitcoin in it, I'd say that's a respectable issuer, you know what I mean? And they're done on reputable exchanges, and you're holding it in an account that you have a lot of transparency, is probably more liquid than the underlying. But then the other leg is to your point about, will the government add this to some sort of reserve? Here it is consolidating again. I think you have to ask yourself, what is the sort of impetus that would cause it to break out and get back above 110? I see more risk to filling in that gap. But again, and the last thing I'll just say is that, our good friend Brian Kelly, he used to do Fast Money with us. He runs a crypto fund. He wrote a book on cryptocurrency. I think it was back in 2013, 14 when it came out. And his view has always been, there's an idiosyncratic trade here. It can only go to zero, right? But it could also go to infinity, given like how new it is and the kind of interest in and around it. So again, I find it pretty interesting. It's a great trader. Let's look at those levels, going forward, because I think they're going to be really instructive.
We have a question from John Hutton. This is actually interesting. It's about Newmont Mining, which reports, by the way, I think on February 20th, John. It's been a complete underperformer, and this is a stock that last time they reported earnings got lambasted. If you go back and look, I think it was in October or thereabouts when you had this huge move to the downside. I thought it would stop at around 48. It didn't. As a matter of fact, I think it got as low as 36.5, 37. It's recently gotten back on its horse. Obviously, if you go back in time, Newmont Mining has not performed at all in terms of a commensurate with gold. On the flip side of the coin, I mean, not that we're playing the game again, but Agnico Eagle Mines, AEM, continues to make new all-time highs. So there's your Newmont chart, which has been a disaster. I mean, Agnico is a gold miner. It's been completely the opposite. So what it basically says is not all gold miners are created equal. With all that said, John, I still think Newmont Mining is just way too cheap here, given where the price of gold is, Dan.
Yeah. You have a good sense for these miners. The volatility has been crazy. The difference in differential in performance from Newmont versus Agnico is pretty fascinating. It goes to tell you that a lot of these stocks actually do trade on their fundamentals, right? Rather than just kind of tracking the underlying commodity price. So, all right, that was the chart of the day, guy. Let's go to the call of the day. This is Evercore ISI. They're saying to trade NVIDIA on the long side into the print. That's February 26th. And so one of the things I thought was really interesting about this last week and a half is that we had Microsoft, we had Meta, we had Google, we had Amazon. The big focus of all four of those earnings was the guidance for 2025 on their CapEx. And there was a really interesting sort of setup because, Google and Amazon and Meta were at all-time highs. Microsoft was well off its highs. But when these companies, issued their CapEx guidance, and again, this is a moving target. They're just kind of issuing a number that they think they're going to hit, a year-over-year increase for all of them. As Microsoft and Google got hit pretty hard. Google was down 8% on their number and 6% for Microsoft. Amazon on Friday was down 4% after they gave a much bigger CapEx number. And then Meta had already previewed that CapEx number of at least $65 billion. And so those two stocks acted very different, in my opinion. And one of the reasons, and this is something you've been highlighting for a long time, Meta has used the technology, the underlying technology, for their own business. And they've seen a reacceleration in revenue growth and earnings growth because of the use of that technology. Investors were willing to give Amazon a pass because, again, this is a technology that's very important to their own business, but also hosted on their AWS, right? So when it was Azure and Google Cloud, they're not using this as much for their own business. Google should be, you know what I mean? Microsoft should be, but they haven't seen a big uptake so far in their Copilot. So thoughts on buying this into the print? It was down about 25% from its highs last month to its lows recently. Big rally here, big gap to fill. Are you buying the call today?
Yeah, I understand this call, and I understand the want to play stock market in a bull market, in a name that everybody's loved, in a name that people will chase into earnings. So making a call like this, I think there's a limited risk and a pretty high reward. But with that said, I mean, Doug Cass put out an article earlier today, and a lot of people have been talking about sort of, we used the term earlier, diminishing marginal returns, and what is the true payoff and what is the true ROI in this whole AI phenomenon. And listen, I get NVIDIA, I get why people are excited. We have pointed out now on 3 different occasions, you've had formations that have led to pretty significant downdrafts. We just saw one. I think we just probably filled a gap that was created on this latest downdraft, that Monday of DeepSeek. You want to play a little stock market here and hope for a greater fool's theory, but I think we're about to start seeing quarters where the numbers that come out do not thrill people the way they did before, and you're going to start to see some margin degradation, and it's a stock that people are going to start to look at, not in terms of price to earnings, but in terms of price to sales, understanding that they're not going to enjoy margins in the high 70s in perpetuity. So listen, it's a fun stock market call. I get it. I'm sure there's going to be somebody else that does it ahead of that release. I just don't know if you want to go balls into the wall here with NVIDIA into earnings.
Yeah, I mean, to your point, it's just started to fill in that gap, Guy. If it were to fill in that gap right before the print, that's not a great setup, to be honest with you. You'd much rather kind of buy it when it's kind of down 25% and you think expectations have been lowered. You've heard me say this a couple times over the last week or so. I mean, I think this is kind of an inflection point in the generative AI trade, right? It's a very narrow trade within the public markets. And I just feel like the response from Google and Microsoft to their CapEx numbers, pretty interesting. Amazon did go down 4% Friday after its numbers, but maybe that was just because it was hanging in there pretty decently, did not go down much in sympathy with the others. So, have at it, as I would say. One thing, Guy, I wanted to say, how you start to show off and you say it's February 10th, the month is going like that, right? Well, we got a holiday shortened week next week, right? We get through this NVIDIA earnings, I think, on the 26th. We're 2 months through Q1. Let's assume that we're plus or minus, 2% or something like that, right? So let's think about this. We came into the year, I think FactSet consensus for earnings growth was what? 13% or so. Maybe like, some analysts or, strategists are as low as, let's say, 11.5, some are as high as 14.5. Okay. So last year, coming into 2024, I think the FactSet consensus for earnings growth was about 11%. And we ended up, I think, about 10% when it's all said and done. And we had an S&P that was up 25%. So here we are coming into 2025, right? Expectations, like I just said, are for higher growth. 13.5%. Now, coming into 2024, I think rates, you know what I mean? Let's say they're about the same, dollars up a little bit. We have uncertainty around a new administration and trade wars and this and that, whatever. So how do you get, if people are making this comparison that we could be in that 95 to 99 phase where we saw 5 years of consecutive 25% returns because of a secular shift in technology that was going to transform the entire economy and the like. It's going to be like, let's just say we get to the end of Q1. Let's say we're up 5%. There's a lot of heavy lifting that has to come, right? Because like, you don't even think about that. Like, what will be the impetus? Is there a next leg of this generative AI trade? Because it's got to come from those names that drags everything higher.
It's got to come from 10 names. The math suggests it's got to come from 10 names. Doesn't mean that other names can't do well, but the math around those names, I mean, they have to do the heavy lift. And you brought up a bunch of different names over the last week and a half, 2 weeks that have reported earnings, and then the commensurate move has been to the downside. So what does that mean to me? It means, fine quarters, but in this environment, given the valuations, it's not good enough to be a fine quarter. It's not good enough to guide in line. You got to continue to excite people. And at a certain point, I think the bloom becomes off the rose in terms of what you can do to excite those people. Now, there are names that still make sense, but they're not going to drive the market. And we have a question around one of them. Look at Walmart. This is from Chris L. Throw that question up. He or she is comparing it to what we saw with McDonald's. think it's two different stories if you ask me. I mean, there might be similar customer base. Obviously, McDonald's had that downdraft a couple months ago on the back of whatever virus was ailing their, few restaurants in the Midwest. They've gotten through that. Walmart, to me, people are going to knock it on valuation. Walmart continues to work here. And as we continue to grind higher every day, as you said earlier, they're the one company that seemingly has been able to figure out AI and be able to sort of use it to enhance and enrich their margins. So I think you got to stay with Walmart here.
Yeah, I think there's a lot of risk to it, though. Like, if they can just pull up a chart, I mean, this looks like NVIDIA if you kind of change some of the prices on the axis. And, the way I think about this is the moment that they don't see like a meaningful reacceleration on a quarter over quarter period, right? I think this stock gets hit, Guy, because the e-commerce number that I think it came in at like 21%, which was better than expected. I just feel like at 36, 37 times, fiscal 2026, which is going to be the current fiscal year with 12% expected earnings growth and about 4% expected revenue growth. And you start to see, the spend that they have, maybe that is kind of weigh on their margins. I just, again, it's easy for me to say I don't like it here. It's kind of cherry picking. And this is a name that you've kind of been buyer of on any pullback. And there haven't been many of them, but this is not a normal move for a stock like Walmart. I mean, that's just my 2 cents.
100%. I mean, it should not trade like a technology. You're 100% right. And yeah, there are reasons for concern, and those reasons around valuation and any misstep or listen, I mean, they're not going to be immune to a downturn in the economy either, but right now they're seemingly winning in just about every environment. So we'll see how it plays out. Real quick, Chris L has a question about Spotify, something you've been talking about for a while. They reported, I think, on February 4th. I think the stock went up about 9 or 10%, maybe higher than that post earnings. The question is, what's the deal with Spotify at these levels, Dan?
Well, the company is basically inflecting, in my opinion. Last year was the first year of like GAAP earnings growth, right? Or GAAP profitability, excuse me. And so they are basically, increasing their margins. They put through price increases. They're adding their other products. They've gone hard into podcasts. And then once they got audio podcasts kind of, sorted out, then they started adding video, right? They have some different tiers of pricing. I mean, is it getting a little over its skis? Yeah, but there aren't too many companies that I can think of at this sort of scale that are growing, sales at mid-teens, and their margins are improving, and you see like at least 30%, earnings growth. But that being said, there's very few ways to play this theme. You can't play it within Apple, right? It's kind of a rounding error there. Netflix, if they want to pull that up, obviously a pretty similar story, but they're not into the original content game. But look at what's gone on there. If you want to pull that out to a 5-year from the 2022 lows, it's pretty astounding, especially after we know what happened in 2022. So again, I just can't. I've been doing this a long time. I just can't chase stories like this. You have to buy them on pullbacks. If you look at this Spotify, you believe in the story and you think there's margin expansion and you think there really is an inflection point and you think there's scarcity of these names, but I just can't buy things up on a spike. Guy, I want to hit one thing before we get out of here. So we just talked about that expected earnings growth coming into this year, right? And what the expected, on average, what does price performance, how does it relate to, right, expected earnings growth? And, I went over to Perplexity, and I know you don't use the Perplexity, but this is something even a guy like Guy Adami might start using when you see how easy it is to get this information. So I was thinking about those year-over-year expected earnings growth. So I just put this prompt in over the last 50 years. What has been the spread of the S&P 500 earnings growth and the return of the index? And look how succinct that answer is. Now, maybe it's too succinct for you. Maybe it looks too clean to have that come up in 30 seconds, but look at the citations up above. Like, you can click through any of those and see where, they're getting their data from. And, listen, you got to click through, by the way, because macro trends, I don't know what that is. Guru Focus, I don't know what that is. I don't know what the other ones are. So you got to make sure you're getting the right information. But what I found interesting about this guy is that the average return, right, or the average annual earnings growth for the S&P is 6%. The average return for the S&P 500, including dividends, is 10 to 11%. So it's not 2 to 1, which is kind of what we were talking about last year, right, with 11-ish% earnings growth and a 25% return. But it helps you kind of put some sort of framework around that way of thinking.
Listen, I'm assuming it's right. I mean, you're saying where they source their information from. But it's cool that you can get an answer to a question like that in such short period of time. I mean, but again, it's sort of not my jam. But to your point, if the math is right, I mean, it speaks to when you see historical norms and where we are now. Maybe it's justifiable the valuations we're trading at. Personally, though, I don't think it is, and I'd have to sort of drill a little bit deeper. Real quick, because we got about 8 questions about Palantir making a new all-time high today. Again, we talked about it. Now the stock, I think, is trading with about $260 billion market cap. Again, I'll be generous and give them $5 billion of revenues. You want to throw the $5 billion in cash on top of it, that's fine. I mean, a lot of people wouldn't do that. I mean, depending on what you want to use, it's trading either 50 times revenue or 26 times. And that to me doesn't make any sense at all, Dan.
Yeah, I think I opt for the 50 times. I mean, listen, I think it's great they have that cash on its balance sheet, but when you do the number now in a $260 billion market cap, listen, if I'm them, I am selling stock hand over fist. I'm doing a massive secondary. I'm looking to put another 10 billion on that, because we talked about this in the going back to, let's say, the dot-com bubble, a couple companies, Amazon was one of them. They did a really big convert, right? And they raised a lot of money, and that convert never converted. And that really helped them out a great deal when their stock went down 80%. And the company hadn't really had any earnings. I don't think the company earned money for, at least 10 years from it going public. So if I was Palantir, I'd be selling stock and putting cash on my balance sheet. So, who knows? And if that were to happen, it probably goes through 100 on the downside and maybe fills in that gap. But if they came out tonight and we're going to do a few $1 billion secondary, it probably comes at like 107 and 108. And this thing I'll just say is when you see what the demand looks like, that will be very telling about who the buyers are. I think we read something last week that this is a retail driven phenomenon here, not as much institutional, Guy.
Well, it would be interesting to see if in fact they did it, where it would be priced at and what kind of demand, because the way it's trading suggests it would be oversubscribed. But to your point, where's the demand coming from? Before we get out, real quick, Palo Alto reports. Let's take a look at that. I mean, this is a name we've talked about for years. This is sort of the gold standard in cybersecurity. The good news is it has been lower left, upper right. The bad news is you've had some huge downdrafts along the way. The question is, you want to continue to play it to the upside, or do you want to wait for the downdraft potentially to the trend line? We'll see. This is what I will say. People are going to knock this on valuation. It is expensive. This is one you just got to find an entry point, close your eyes and say, you know what? This is the best in class. And I just want to be long a stock that dominates the space.
Yeah, I mean, mid-teens earnings and sales growth, 77% gross margins. They have, like you said, they've been, they are the market share, right? And so obviously this is a pie that's getting bigger here, but those downdrafts are hard. And we drew that line, from that kind of late 22, early 23, and it has not been an easy trade. So I like the way you kind of phrased it. You got to kind of find an entry point, not when it's on one of these big spikes, but if it's holding that kind of uptrend. You see that 200-day moving average at 173, that uptrend is probably 170. It's trading just under $200. That's a 11-12% move lower, and the implied move in the options market is probably about 10% in either direction. Let me look it up right now. It's about 7-8%. So again, this is a tough one to buy into a print. And given some of the news that we've seen out of some of these companies and their guidance and some of the reactions, I just think that this one could easily move 7 to 10%. And if you get that wrong, you're not going to find that good entry point because you're already in it.
I agree with you 100%. I think this is a wait and see. But to me, you're looking for an entry point to buy. And it might be in the form of that trend line, which again, we've tested a couple times, so we'll see. But that's it, Dan, because as you can tell, I got to sort of get my tie on and head on to New York City for CNBC's Fast Money tonight at 5 p.m.
Yeah, I'll see you up there, Guy. I will not have a tie on, though, by the way. I will not be wearing a tie.
No, but that works. it would be odd if you wore one. It would be odd if I didn't. I mean, that's just right. I mean, that's just the way it is.
You know what? I would love to be able to roll up like this. You know why? Because this is how I go to work. You know what I mean? And I don't, but now I have to put a sport jacket on and put a nice fresh shirt on and put a belt on and maybe change my trainers out, guy. You know what I mean?
What?
Like the whole my sneakers, like the trainers. They call them trainers in the UK.
Who's they? My grandmother used to use pronouns. It used to drive me effing crazy. They are all wearing that, little guy. That's what they're all doing now. I'm like, Grandma, who the fuck are they?
Whoa.
And I would say that. No, I would say that to her.
Really?
She was about 5 foot tall Sicilian woman. Yeah, she responded because it drove me nuts. I'm not interested in pronouns. Little guy. And first of all, she should also know me well enough that if everybody's doing it, I wasn't going to do it.
Yeah.
She was better off saying nobody's doing it, little guy. Maybe you should think about it. Then maybe I would have thought about it. But no, they're all wearing it.
Was she talking about like those little knickers, those little shorts that the kids were wearing that they looked like,
it's not going to come as a big surprise to you. I wasn't hanging out with the boys. I wasn't comparing what'd you call them?
No, knicker. Like the little things,
trainers.
Like Oliver Twist used to wear. You know what I mean? Yeah. Those like pants that go down to your knees, and then you wear like no, it's not your jam.
No, I was
making an old joke, by the way.
No, I understand Oliver Twist. I get it. It's just if everybody's doing it, there's a very good chance that I'm not.
Fair enough. All right, please, sir. Can we come back tomorrow, 1:00 Eastern?
We will. Carter Worth might be with us. I don't know, but Liz will be with us on Wednesday. So
that would be amazing. All right, see you guys.
See you later.